This conversation here is our fireside chat with Jim Freis and Stephen Scott on uncovering fraud in global fintech and how and if fintech gets a pass given its allure. So really looking forward to this conversation. And Stephen, Jim, I'll hand it over to you.
Terrific, Nick. Thanks very much. And thanks to Howard for having us. I'm sorry we can't be physically in Bonnie Doon with its always serene outdoor setting. I've tried my best to create a serene outdoor setting on my side just to keep to with the spirit of the event. And delighted to have Jim here. His background, I think most of you will be familiar with, but he has a long and distinguished career, having worked with the New York Fed, having worked with the Bank for International Settlements, having worked in legal private practice. Jim was the longest serving director of the U.S. Treasury's FinCEN, the Financial Crimes Enforcement Network, and was the chief compliance officer with the Deutsche Börse Group when he got a phone call to come down and join Wirecard. So in sum, Jim's a guy who knows quite a bit about these topics. So Jim, welcome and thanks. And maybe just to kick off our conversation, you can sort of give us a little bit of a sense of history. How was it that you came to be involved with Wirecard, and more importantly, perhaps why?
Thanks very much, Stephen. Maybe just to set the scene for those of you who may have heard the name but haven't been following so closely, Wirecard is one of the most interesting, I think also for this space, financial stories of the past year. It was known as Germany's most successful fintech as a payment services processor operating globally, literally with operations across 6 continents, and came crashing down in dramatic scale last year as a result of my uncovering massive fraud within the company. To put it in perspective, Wirecard otherwise, in a lot of its legitimate business, would have been one of the main beneficiaries of us in struggling through the coronavirus time, because it was one of the early adopters of the idea that internet payments, those not tied to either bricks and mortar firms or even traditional payments processing units, are the way of the future. And all of its peer comparators and direct competitors are among those that have had multiple gains in the past year. Not in any way to bring any of the scandal or any disparity in there, but again, just to put it in perspective, in the past couple of weeks, we've seen that Stripe is the most highly valued private equity firm through late stage venture capital ever to come out of Silicon Valley. Stripe is one of those that had one of the closest business models to Wirecard and its legitimate business. So that's what we're looking at here, and that fell down in what's known as the global Enron in terms of massive accounting scandal and questions that still reverberate in terms of potential reforms. Stephen, to come back to really your specific question, how did that involve me? Because I started my career in payments, and when they came to me and said that we have a company that has far outgrown its roots with the same management that basically started it out, the guy who's got his PhD in technology or engineering, and we need to bring in a professional management team. And they specifically wanted me as part of that team because they were struggling with the notion of a technology company in the financial services space that had some subsidiary licenses, but wanted to apply for a few more, especially those that would allow it to effectively double its profit margin by taking not only the technology side of moving data, but also the acquiring side and doing the first payments processing instead of passing on a fee to a bank. And that frankly sounded like a good offer a year ago this time.
And Jim, you used the term legitimate, and I know you focused on this in the past in making a clear distinction between the legitimate and the illegitimate parts of Wirecard. I think that might be helpful context for this conversation as well. Can you say a bit about that?
Absolutely. So there are Wirecard's illegitimate business, or what led to its downfall, is like Enron. It essentially had inflated revenue numbers and therefore inflated profits for years, which were carried over in its audited financial statements. As a publicly traded company that grew to be almost $30 billion valuation and one of the top index components of Germany's leading industrial company. So this wasn't a fringe company. It wasn't one that was in private equity. It was actually at one point the most traded stock in Germany and a big global index component. It was a real player in these payment services. Some of the main customers that it had, it was one of the biggest payments processors for global airlines industries. So if you wanted to fly on Singapore Airlines or KLM Air France, name carriers, and you logged on anywhere in the world, any language, any type of payment, whether it's a traditional credit cards or regional credit cards or Alipay or PayPal, they would process it and get the money through to the customers. It had bought a portfolio from Citibank, global issuing business, which is the flip side. It's essentially your mobile wallets. I was familiar with that business, including the part that I would have overseen based in the US, but also a dozen countries throughout Asia. And again, it focused on a lot of big name merchants. The problem is that that business was marginally profitable, or in some cases, loss leading. And that's really kind of the whole interesting aspect of it, because when we talk here and you say, okay, I've got a business that has good technology, entirely scalable, right? So I have the fixed costs that I've shown that it works with big players like the global airlines business, and it cost me a little bit of marketing and not much more to bring in every additional merchant. I'm growing globally, especially into markets where I don't have as much competition. If it had never turned a profit, it still would have been worth billions, right? But apparently there was not that interest in waiting so long to achieve those type of multiples. There was inflating, as I said, of the revenue and thus the profit numbers that allowed the company to borrow more on the capital markets. And that's the other side of the scandal that only came out afterwards, that you had misappropriation, so stealing from the company from persons inside in connection with associated outsiders. And the question is this really a one-off case, or are they things that we need to take more seriously? Because I can tell you that one thing is clear, that had Wirecard not veiled itself within the mystique of being a fintech and being able to say, well, if you question why we're able to grow so quickly, then you obviously don't understand our disruptive model and get out of the way.
Yeah, so that's a great segue to sort of my next question for you, Jim. And as you'll know better than I, regulators around the world right now are really struggling to grapple with the fact that so much of the financial sector is no longer seated with the traditional financial players. We are working from a regulatory playbook that is built for the likes of Citigroup and Goldman Sachs and JP Morgan, and trying to contend with the activities of an Alipay, a Wirecard, a Stripe. So given that, and of course all of that is now accelerated by the disastrous example of Wirecard. So given all of that, where do you think we're headed next in terms of regulatory priorities around this stuff?
I think there's a few different dynamics in place, and the biggest aspect is regulators understand they need to be a little bit more proactive, try to get their hands around these things and not expect that they will move into the traditional holes. Although again, there are a lot of fintechs that are applying for financial services licenses, as I said, in part because they realize that they can take on the fees, not serve as essentially a white labeling for other companies. And there, I think, is where we have quite a differentiation here within different parts of the market and the size. A lot of fintechs came in or developed in essentially a monoline fashion. They said that this is an aspect of the sector that we are trying to do better, more efficient, without the legacy baggage, and we can do that thus cheaper. The problem is that that's not something, talk about peer-to-peer payments, right? Most of the players can do that. They can offer something that transactionally works, but it's something that you actually make money out of, or in any type of volume. Not really. Or there's not a lot of players compared to those who've actually entered those markets. We see more and more those fintechs that are partnering with the traditional financial services sector. It's either being bought up or again, type of white labeling. And that means that you are no longer a disruptor. Again, you're a partner in a model. Or we see the fintechs that are expanding and they're saying, I sit on a lot of investor money, the float as we would traditionally call it, but without a bank license, I can't lend it out, right? And I could do more with that if I leverage that. For that, I need a bank license. And so they're actually moving into the broader sector for which they need a type of licenses. The biggest question for regulators in that second side, well, the biggest question for the first side is know your outsourcer, know your vulnerability there. You can't just say, I've outsourced that in some black box, right? And that's a big regulatory push. There's currently a range of different regulatory initiatives that are out for comment now. So we'll expect more focus on that in the coming year, tied to cybersecurity, business continuity, et cetera. On the other side, for this broader entity that's providing multiple services, it's a question of, do we put it under the traditional ownership of bank holding company type structure, where we say there's limits as to the related business and what you can do? Or do we let a technology company and a technology company management operate that? That's the debate directly from Wirecard, but frankly, something that we don't have that much example of here in the US, because it's one of the part of the Glass-Steagall going back to the Great Depression reforms now 90 years ago, that we've not allowed industrial companies, with rare exceptions, to actually own banks or provide these financial services. So that debate is here anew for us, and it's more pertinent than ever.
So in the context of that debate, let me draw you out a little further, and forgive me for throwing a double-barreled question at you, but look, when you joined Wirecard, there were already criticisms of it out there in the press that you would have been aware of. And at the same time, you've just described them as doing a whole mix of interesting things. So two questions. What was it that drew you to Wirecard, and the role that you were offered there, given some of the misgivings that had already been made public? But let me also draw you out on the comment that you just made earlier about fintechs, and I'm sure this is relevant to many who are listening into this conversation, having a choice between acting as disruptors or partners to the industry. Do you have a view on which is the right way to go? Are both right, and it's a horses for courses kind of a question? Maybe you can reflect on that as well.
Sure. So the first question, in terms of myself coming there, yes, there were allegations, there were issues that the company had, but frankly, it's when you have setbacks that you change. You had a management team, the four most senior persons in the company that had been there for 15 years. That's a long time when you go from essentially a nothing, unknown company to one of the world's largest players in that regard, to not have brought in other experienced managers. Red flag, if you will, in a way. But in the announcement that I was coming on board, it said we have a sustainable and highly profitable business model. And I was told not only would I have the executive ability to make changes, but when you have money, you can do that, right? It's usually only after there's a penalty on a company. So a regulatory penalty, a setback. It could be because they've lost the data protection fight, that they then invest and they hire a different team or they change aspect of the business model. So that's part of what I was doing. But again, in an area that is taking off. The pie was growing, and clearly they were ahead of the competition and looking at digital payments. So again, something to be fun and creative as part of the strategic direction. To your question about the disruptor versus partner, partly it's a time horizon issue. And the other part is it's a segment in where you're looking to play. So one of the biggest trends that we'll be talking about again and again here is the movement towards disintermediation of a lot of actors. And Wirecard, or my career, has generally been in the cross-border space. More in the cross-border space than even domestically, but even domestically within jurisdictions, you have a lot of players in the market between, ultimately in the most basic sense of finance, the saver and the borrower, right? And the aspect is, should we have crowdfunding, right, to allow individual savers invest in the individual borrower's idea? That's the classic aspect of the disintermediation. It's also one where it's really a caveat emptor. We see the buyer beware, or in, as I mentioned before, the P2P payments model. It all sounds good when you have funds with whatever the thing is on your mobile phone, whatever that different brand is, until that money disappears, right? That's why to be in that payment space, you need to make sure that customer funds, as a money transmitter without even going in a banking license, are segregated and not just the operating cash in your pockets. Or the whole debate that we have over Tether that's not really fully resolved. Is it actually backed by something as a stable coin, or is it not? Or how much is it actually backed by? Or they just got another audit statement that came out last week. Are we more comfortable with that than what we've seen before? There's others that come in with a different model in that. But the disintermediation will take time, and you will have parties together with the traditional players for a while. So some people are looking again to partner in that regard. Some are looking to go directly. I've come from different ends, up from the central bank and the finance ministry side, and they're always going to be there, even if you disintermediate a few players in the chain.
Thanks, Jim. So, look, after a long and distinguished career, I'm sure that you feel that the pinnacle of your career is having joined my company as an advisor to me. So if I can indulge myself and ask you to address some stuff that's a little bit central to what we think about at Starling, but of course is highly relevant to everything that you've just shared about Wirecard. So in both the traditional financial services sector and now in the new fintech sector, what's come through clearly over and over again is that there's a whole range of non-financial risk issues that are material, that are poorly captured in financial disclosures, and that reflect perhaps underlying cultural predilections that we know regulators are increasingly concerned about. I wonder if I could ask you to reflect a little bit on that. Why is it that we keep seeing these same sorts of problems over and over in this particular industry, whether it be old-fashioned firms or newfangled firms?
Well, I think first, as you said, non-financial risk. When I think of financial risk, you're mostly talking about credit risk, could be liquidity in market, depending on what you're doing. But operational risk is something that we all live in with, particularly in a technology environment. And as good as our technology might be in the level of straight through processing and the like, the algorithms are what people have programmed. So they have those type of bias in them. And otherwise, essentially, your operating risk are the people element. I've always said throughout my career that if we just dealt with numbers, we'd be pretty rational. But as soon as we throw people in the mix, you can throw the rationality out the window. And frankly, in the financial industry, there's, or financial services sector, including technology-focused services, you have fungible value here, with the exception of NFTs, but that's a different situation. And any place where you have fungible money, and more so when we move to real-time payments and straight through, there's no room for error, right? That's one of the things that a lot of individuals have found out the hard way. There was actually a study that came out from the UK in the past couple days. No surprise to me, but most of the consumer frauds were tied to payments that were requested through the real-time payments mechanisms, and in another nanosecond, that's gone. That money's never coming back. In the traditional way, if you put something, or you showed up with the credit card bill, you had 30, 60 days to contest that. Or if you had T+2 payment processing, it might get held up in the fraud network, and then you had a chance to raise some questions. Was it a fat finger aspect? Was it really authorized? If it's one payment and then it's gone, it's really gone. And that's something that fraudsters can take advantage of too.
Thanks, Jim. I'm just conscious of our time. I think we've got maybe 5 minutes left. And so let me just ask Howard, if you'd like to allow anyone to pose a closing question to Jim, maybe you have one yourself. I'll afford you the floor for that.
I'm curious what you've seen as the consequences of the collapse of Wirecard afterwards, in terms of both the impact on the payments industry and the fintech industry generally, because I'm assuming that all that business, on the one hand, went to the competitors of Wirecard, and that so if it was processing all these transactions, that was a lot of business that went there. But then there was also, of course, the experience, the sort of the trauma of having seen what happened to Wirecard, and so people, I'm sure customers and others, became very wary. So what do you see as the immediate consequences of the collapse of Wirecard?
So there's definitely more focus on risk than before, and that starts with regulators, auditors, those in control or oversight structure. So when I say regulators in that sense, applications have slowed down and they're asking more questions than before. The auditors, knowing that they could be burned or may have personal liability, are looking a little bit closer. And there's more focus on conflicts. I think this is actually one of the most interesting corporate governance aspects to look at. We see even some notable name companies that have gone public or looking to go public, reverse listings, SPACs, et cetera, where you don't have, let's call it, the most independent audit committee. It could be someone that has historical ties, it could be an investor. Some of this space makes perfect sense when you're still in the private equity around, that you're sitting on the board. But are you really coming in with a fresh view and representing the public if you're on a publicly traded board? Aspects of voting shares and non-voting shares. I think that's something that it'll be interesting to see if a premia moves through the market for those who have, again, the highest level of independent control for those with the less level of control. We know that there's a lot of money out there sloshing around, but it also tells you you can't necessarily rely on the fact just that each of the big four were involved, as it was in the case of Wirecard, or some of the big consulting firms, or the biggest law firms, or the regulators, and they had criminal raids and investigations, and the company was still running. That's not enough to say that this company's kosher.
That's amazing. We have a question from Winston Ma. Maybe I'll just read it. Thomas Middelhoff has a new book on why Germany industries missed out the digital transformation. How is Germany doing on digital payments? Is the question.
So it's definitely behind. And again, Wirecard was part of the solution in that regard. You can't just talk about the German market because it really is a pan-European market. And you do have some neobanks coming in and some of the other competitors from Netherlands, France, Denmark, Italy, they're all scooping up that sector within a common market.
Stephen, you may want to just say a little bit about how your firm thinks about these sets of issues too, because you are, of course, involved with non-financial risk as well.
Yeah, non-financial risk is really the bread and butter behind the value propositions at Starling. And writ large, our argument is that most of these non-financial risks, as Jim just articulated, are driven by people and the behavioral choices they make. And when people choose to do bad things, you get bad outcomes. And management is persistently flat-footed or caught flat-footed by these bad outcomes. They're always operating in a rear guard fashion. And so we ask the question, can we use technology, machine learning principally, and large data sets in order to find patterns that allow us to be predictive of behavior so that management is positioned to engage around that proactively. A key to the working of our technology is an understanding of behavioral science and how relationships between people in an organization inform their decision making and their subsequent actions. And I just note in that regard, Jim, you said something a moment ago that's got my wheels spinning about conflicts of interest. What creates a conflict of interest is torn loyalties. Torn loyalties in relationships. I want to preserve the interests I have in this relationship with the interest in that relationship. And so conflict of interest issues are really very much so in keeping with the way we look at the world, social issues. And so what's necessary is really just a different set of questions. However, what I'd close with is we emphasize that risk and compliance around non-financial risks. It's not really a situation that's crying out for better methods. It's not a methodological problem. It's a conceptual problem. And so part of what we're doing at Starling is to try to introduce new concepts into the world. And as those concepts are accepted, people will demand new tools. And we hope that we're well positioned to provide those tools.
And just a last point on that, the aspect that for me it makes it interesting is structures are one thing, and you need to have structures to run organizations. We can call that the 3 lines of defense in terms of the business, the people looking at the risk, the separate audit, but it's a question of a holistic view of how they're working together, not just on paper. Other aspects, check the box. Do we have a diverse board? Wirecard had 50% women on its supervisory board, including people of color. That's only the start to the experiences of whether you had people to really challenge them going forward. And this is an aspect where, with Stephen's leadership, where we think there are ways to see that through data, what's actually happening within the organization, and be a little predictive about it.
One last question. And by the way, I note that the fireplace has been going. I hope that had a calming influence on you as we had this fireside chat. Jim, I don't know if you were here when we had the earlier keynote speech by Brian Brooks about is our bank still special? Did you hear that? Were you able to hear that? Or
yes.
Okay, great. So as you know, one of the things that he's raised is, why shouldn't we extend the charter, bank charters to a broader group of people, including a lot of the fintechs that are doing bank-like activities? Do you think that would have made a difference in many cases, including the Wirecard case, for them to be under the regulatory umbrella of more banking-like regulatory agencies?
It certainly would have, in particular, if you took a holistic view across the organization, because part of the problem was the components ultimately didn't add up, literally in the sense of the financials, but the audits of the wholly owned subsidiary bank, there wasn't really a problem there, or some of the other components. But still, comes back to my point is, what is the sector that you're looking at, the fintech? If you are essentially, we in the US have, with limited exception, and I can debate Brian on the edge of this, but you get a bank license, you can do bank business, which is a long list. In Germany and many other countries, you get a bank license to do a specific aspect of business. And maybe that's the way that we should look at it. It doesn't open the door to everything. And frankly, the problem is when you open the door to everything, you have to put all those control structures in place for everything, even if you're not really focused on that business area. So that's a way to look at it. Again, but again, it gets asked, like, are you being a financial conglomerate, or are you looking for a specific model? And then what are the risks in that model? But the last thing I'll just say in that, and that's really where the regulators struggled and missed the ball with Wirecard. It's not just what the bank was doing as its business, the Wirecard subsidiary bank. It's the bank's risk profile, a business within the technology concern, where most of its customers came to it because of the parent connection. It's a very different risk profile than that of the bank as a standalone entity. And that's what they missed.
Yeah. Very interesting. We are unfortunately out of time. A terrific session. Both of you gave us a lot of insights. Thank you so much for doing this today.